My name is Graham Waller, and I'm the founder of Ultralight Startups. And Thank you. We are talking here today in December 2009, the last Ultralight Startups of 2009, about bootstrapping versus venture funding, which is certainly a topic that's of great interest to me, and I suspect a great interest to most of the rest of you as well. I have many ideas for startups, and I have had for a long time, and it seemed like back in the 90s, you could just have not much more than an idea and go out and raise millions of dollars of venture capital and probably squander it and go bankrupt not too much later and then get a job. But we don't live in those days anymore. We live probably on the complete other end of the pendulum swing.
You got that
in the Great Recession when money is scarce.
So awesome.
But we still believe that opportunity is out there, and it's more a matter of I think we can pick you up on the microphones if you're talking.
Sorry.
No problem. So here we are in this point in the economic cycle, and we're trying to still start our ventures and launch them and have them become profitable and successful. So the question is, should we be bootstrapping? Should we be trying to grow our businesses organically and based on customer revenue and our own money out of our own pocket, or is it even possible, or is it worthwhile to seek venture funding? Are there businesses that are inherently, venture fundable or require venture funding versus ones that aren't? And those are the topics that I hope to cover today. So I'm going to announce our moderator, who's going to announce the rest of the panel, and then we're going to hear from them on their particular experiences. I guess we should go back here for a moment. But Mark Davis, no, sorry, that's not right. Owen Davis, one of the two Davises on the panel, is going to be our moderator. Owen is managing director at NYC Seed, a seed stage venture capital fund in New York City. Since 1995, Owen has founded startups including Thinking Media, an online marketing firm, Sonata, a location-based wireless services and marketing company, and Pedal Computing, a cloud computing company. Owen is the author of various patents in internet methods and technologies and the book Instant Java Applets. Owen was recently named one of the 100 most influential people in Silicon Valley in 2008. So we are honored to have Owen moderating our panel on bootstrapping and venture funding. So thanks very much, Owen.
Sure, thanks. So I will try to speak loudly. To kind of get this started, I'm going to go down the list and ask everybody to introduce themselves. And then when we're done, I'm going to have everybody kind of give a 2-minute kind of overview statement on their general thoughts about bootstrapping versus venture capital and what are the criteria and ways to think about that subject. So, Brian?
I'll work backwards. Currently, I'm the vice chairman of the New York Angels. We're the largest angel group in the United States. We do a lot of deals, even now, during these difficult economic times. We're a group of about 70 angel investors, all individual members. Prior to that, I had the largest high-tech PR agency in the United States. I sold it after about 16 years to the Interpublic Group of companies and retired. And prior to that, I had started a number of computer publications, Information Week magazine, Computer Systems News, and have my degrees in science and technology communications.
Hello, everybody. I'm Art Chang. I'm the founder and CEO of a firm called Tipping Point Partners. It's kind of hard to categorize this because there's really nothing that kind of exists for it. Most people call us an incubator, and what we do is we essentially build internet and mobile-based companies, generally from scratch, and in some cases we actually renovate existing ones. My experience is it's really fun to see all the pitches today. So everybody who pitched, congratulations, and thank you for your bravery in standing up here. My first startup was when I was 17. My market size was 3,360 people in a captive audience in dorm rooms at the boarding school where I was a scholarship student. And in order for me to make money, I came up with this idea that I'd go to the local pizzeria and sell pizza by the slice, because back in 1979 you couldn't buy pizza by the slice in Ohio. And I realized very quickly that if I wanted to increase my distribution and efficiency, that it would be far better for me to start a sign-up list during the week. And we grew it from, about one pizza box a week to about 20 pizza boxes a week, and it grew to about 100 pizza boxes a week, which is about saturation point. But we were doing 100% markup on the pizzas, and it was a great business, and I liquidated by mailing the list over to kids from the next class in school. And so that's kind of like, a short story to what I've done. I've worked on over 25 startups in the past 25 years. I've been in different roles, ranging from the entrepreneur to an operator. I've been an investment banker, raising money for them and doing M&A, and I've also worked in venture capital for the New York City Investment Fund. I'm very proud to say that only 2 of my companies have gone under. 4 of them have been sold, and the rest of them are profitable and or close to it, including many of the ones that I'm working on right now today. We typically work with companies that are with founders that are from very, very large industries who have a disruptive idea, but where their relationships actually can co-opt the rest of the market in participating. And so that's a very interesting angle and a lot of fun, and really look forward to talking more about the stuff on this panel. Thank you.
Hey everyone, Mark Davis. I'm with DFJ Gotham Ventures. We're an early stage IT venture capital fund here in the city. We do primarily seed and Series A investments in companies that we could think can get really, really big. And we're part of the DFJ network, which is a global partnership of 23 venture capital funds around the world, Russia, China, onward, which collectively has 150 investment professionals, $6 billion of capital, and 600 portfolio companies, making it collectively one of the largest early stage venture capital funds. But we're here in the city. We're 4 folks, DFJ Gotham, and we invest locally.
My name is Dennis. I am an entrepreneur. I've done and participated in 4 startups, 3 successful, and 1 that didn't work out, and they were all bootstrapped. And the one that didn't work out, which I paid for by the fact that it was bootstrapped, is probably the most expensive MBA I've taken, but it was well worth it. Today, I work at Yahoo, due to the fact that the last company was acquired by Yahoo last year.
Congratulations.
Thank you.
What is your last name?
Dennis Mortensen is my full name.
Dennis also happens to be the only 2-time panelist at Ultralight Startups.
All right.
Okay, so to kind of get this kicked off, what I'd like to do, or at least by the end of the evening, make sure that we've maybe delineated some of the qualities of a bootstrap company versus a venture fundable company versus a good business, and really at least try to clarify some of the issues that kind of surround these kinds of companies. So what I'd love to do, though, is just kind of go down the list, go down the line, and for 90 seconds or so, just basic thoughts on bootstrapping versus venture fundable.
Well, between bootstrapping and venture fundable is the largest area of actual finance. It's called angel investing. 50,000 companies around the United States are actually funded by angels last year. 800 were funded by VCs, certainly at a different level. The context for angel investing is growing dramatically, and that doesn't even include friends and family, which comes even right before angel investing. And many angel investors now are sort of becoming, many of those people who were previously friends and family are moving into angel investing. So, the context there is that many of the companies we see were, perhaps, they don't realize it, bootstrapped up until the point that they gained some kind of traction. So from our vantage point, we exist in a sweet spot between, let's say, $250,000 and maybe $2 million. Because many of the angel investors today are also collaborating between groups, and that's really exciting. And also gaining money from many of the geographies and many of the businesses in the area who want to participate in early venture equity opportunities.
think I'll use this because I've been working 20-hour days, and so my voice is feeling a little bit weak. But what I'd say is I think in some ways that bootstrapping versus venture capital is almost a misconstruction of a concept. It's extremely fuzzy. The notion is, the thing that we believe in is that there's actually, you focus on building a great company. There are lots of opportunities out there to create a great company, whether that company ends up being worth $1 million or whether it ends up being worth $1 billion. There are lots of rational approaches to building companies. And your path to getting there should not be dependent upon the form of capital that you take in. And so whether it's angel investable, whether it's strategic investable, or venture investable, if you allow those to be the ways that you define your business, it's a tail wagging the dog. And there are many other forms of capital. Your bootstrapping, your sweat equity is a form of capital. Your vendors being willing to forego payment is another form of capital. Nonprofit structures are another form of capital through foundation grants and government grants for projects that are in development phase. So there are lots of different ways to cut it. And so what I tell people over and over again is, don't focus on the capital. Focus on what you absolutely have to do to get to a proof of concept, and then look around 360 degrees and figure out what the next step should be. And part of that decision is the form of capital.
Graham, can we cheat and put the slide up?
Sure.
I know you made a slide out of it. So,
First, the other first.
I'll just do that one.
Okay.
So I write a blog on how to raise capital. I'm trying to write, I've got about 300 short essays now, and they're put together in a table of contents, so it's relatively easy to navigate and find the different stages of the fundraising process. You may find some of it helpful, but this is one diagram from that content, and Graham asked us to post some blogs before the panel, and I put this up as a repost. And he thought it would be a cool idea to share it here. So this is one different cut of it. The answer of whether you should bootstrap or raise venture capital, there's a lot of different considerations, many of which are whether or not you should be in business. But if you should be in business, what I've tried to do in a very gray, complicated world, and I'm sure there are many exceptions to this, is try to simplify the decision-making process for figuring out how you should finance this. And so this is I'm an ex-consultant. I remember I first posted this, someone wrote some nasty comments. This guy must be a consultant. It's true. I worked at Bain for a bit. But this is hopefully a simplification of the process. What I've tried to point out is there's two things that I think are core considerations in figuring out how to finance your company. One is the amount of capital you need to get to break even, and the other is the scalability of the business. I'll just quickly walk through it. Can I go over 90 seconds?
Yep. Of course.
Okay. So I'll start with the bottom right scenario. If you need a lot of money to make a very small business, you probably shouldn't start the company. That's the first one. So that's a big X, okay? So if you're in the bottom right, that's bad. If you need a lot of money to make a very big business, you probably are in the top right, where venture capital is one of the paths forward, probably the most common path if you're in that bucket. If you can make a small business with relatively small amount of capital, there's a bootstrap option. Now, I've used bootstrap in the extreme. Yes, there's angels somewhere on that. There's a bunch of other scenarios, all the shades of gray in there. I've just tried to point out the goalposts here so people can get a sense of how to think about it. The complicated place to be, in my opinion, is in the top left, when for a relatively low amount of capital you can build a big business. And so I've tried to bring up probably the two, what seem to me the biggest second consideration to figure out how you should finance your company after you've figured out you're in that bucket. And to me, it comes down to barriers. Venture capitalists, in my opinion, for my investment thesis, really value barriers are critical for driving scale in a company, which is another chart we have, but we won't show right now, if that's okay. But from your perspective as an entrepreneur, the stronger your barriers are, the more I would probably be inclined to bootstrap. So let me give two extremes. If you have IP, you have a patent on a new type of dirt that everyone wants to use and buy, you might be able to raise a very small amount of money, grow it slowly. You have 20 years, no one's going to be able to take market share from you, and own more of the company. If you're in a land grab business, let's say you created the next ad network for a new type of inventory, but 10 other people are creating it, and whoever gets big first wins, you probably want to raise more money and go on the venture capital path. So almost contrary to probably the way a venture capitalist will evaluate your business. The weaker your barriers are, the more you should be inclined to bootstrap in this particular scenario if you don't need a lot of capital. If you need a lot of capital, you should raise venture capital anyway. But that's a high-level structure, I think, to think about this. I'm sure there are plenty of exceptions. I'm sure the panelists will point out all the holes in this. But, it might be a good place to start for the conversation.
Good.
I think my definition of bootstrapping it is anything but taking venture capital. And I actually get disappointed whenever I see a post on VentureBeat or TechCrunch where people celebrate the fact that we took $8 million in funding. Because for me, taking $8 million in funding is some sort of defeat, isn't it? Because I lost equity. And if I lose equity, that's kind of the point of doing the business to begin with, which is either that I want to be happy, and if I want a proxy for happiness, that could be money, and I'm losing that as well if I do get to the point of exit. So for me, if I'm going to look at this one, which usually when you look at any visualization is based on data, which this isn't. This is based on opinion, right? So, so if you look
He warned
at this
me he was going to be brutal
base,
before the panel.
I'm a data nerd. So if you look at this and just apply a little bit of data to it, what you would see is that go a decade back, you would probably have the not viable being a whole lot larger, simply
Sure.
because it wasn't really that easy to go out and acquire 100 servers to do whatever software company you want to do. But today, this one actually ends up here, if I'm to actually visualize this. So the whole not viable is not really for the VC to decide, that is for you to decide. So it's always viable. You can always start your whatever project in the cloud or with whatever open source software foundation that you find viable for the project. Then the other way around, which is a strong barrier to entry. I'm just not a big fan of IP, and that might be because I'm from Europe, and I just don't believe in the whole idea of you trying to compete on fake barriers, which is that I invented something first.
What types of businesses did you start?
Whatever I say is only related to tech companies. So anything beyond tech, I would have no knowledge whatsoever.
Cool.
So in regards to tech and whatever IP you can create in regards to tech, even those IPs that you do create, anybody can reverse engineer and come up with a better model for what you just have done, which is not your IP, but something that's similar, a little bit better, a little bit worse. So I don't think this really is true to me. So my graph would start here, end up here, and this corner would be venture capital. And that means, and I'm actually serious, because the line goes here and the line goes here. So the blue is just a little dot up here. And that should be not out of business, but we failed, so we have to succumb to the fact that somebody needs to give me money, and we will accept it, but we'll certainly not celebrate it. So that's my point.
Okay, so there have been a few opposing viewpoints represented here, and who wants to go first to rebut a couple of those?
Well, there's
you
so
wanna
many
go?
places to start. I mean, it's
Yeah,
certainly
So I'm happy to respond.
Why don't we take one general topic, the largest topic, and we'll kind of break it down.
which was the largest?
Yeah, what do you think the
well,
largest was?
really any of them that you'd like to. There were many of them.
Well, let's see what facts we can actually come up with, right? Tangible things. I think venture capital is great if you need it, right? You go to a doctor, you have, cold, you take a certain, need of pills or a diet, you take it. There's gray areas, and it's a strategy. You ask yourself, what do you need, when do you need it, period. So it depends. So it may get sort of, curiosity and laughter, but to sort of make it a simple conversation is not really giving you the best of advice. And when I see companies come into the Angels, we don't ask, gee, will they allow us to take equity from them? No. We ask, how can the money help them achieve their goals? We don't look at it like that. And by the way, neither do they. They say to themselves, there are things we need to build, things we need to buy, people we need to hire. We have a strategy to grow. And
what we ask is, how little do you need to be able to get to places so that you can increase your value? Because if we do that, then our initial investment is better off too. Because if we allow the business to grow and prosper incrementally and opportunistically, and they don't need any more money, that's great. That's fine. That's a good thing. So it's kind of weird. Statistically, if you took all the venture capital of the last 10 years, and these numbers are now becoming more available as you look at them, the venture capital industry is underwater. It was a wonderful business when they started. They were doing the same thing as angels years ago, but they got too big, and now they have to give usually $2 million and above, but there are many of them coming down. They're looking at super angel kinds of things and stuff that Josh is doing with Mint.com and so on. So just to be clear, funding is a strategy. If you need money, it's a strategic rationale why you need it. It's not a bad thing. You may have had some great successes. I do put to you, by the way, give me a bunch of companies that have bootstrapped that have been successful.
You want to respond to that, or can I respond to some of your stuff too?
Okay. My response would be, you said facts, so that response was not a fact. So those are not data points. So if you take a look at some of the data points, which is, and I'm of course extremely colored here, and it doesn't mean that you shouldn't take venture capital. I just don't see the point in taking it. Okay. So if you look at some of the numbers, it looks like if you take a angel or A or B or C, you need to at least increase the multiple as you move up that ladder. I think we agree on that. So that's a fact, right? So the multiple for which I can exit is low if I've taken your angel funding, and it needs to be a whole lot higher if I take a round D from you, right? I can't sell it for a 2 times revenue if I've taken a round D for $50 million. That's a fact.
I think your point is supporting this. I mean, the whole big concept.
My point is that I need to increase my multiple as I start take in
smaller
external
percentage, bigger pie versus big percentage, smaller pie is what you're saying, right?
No, that's the happy story.
Well,
that's the pitch that the VCs gives. That no, we'll do the $1 billion company together, so your 2% is going to be a whole lot more valuable than your original 35%. And if you look at some of the stats in regards to that, it might end up being a similar value, but from your start to your exit, you simply extend that. And we've seen, these are the stats. So if you get VC funding, from you start the company to you actually exit, what is that, 10, 12, 13 years? You must have an average in your fund as well.
The average, by the way, is about 9 years of an angel investment.
Yeah, it's 7 to 9 years in venture.
Yeah, in venture, yes.
Yeah.
But from I start to I take angel to you come on board, I spent what, 4 years? I take you on board, that's 7 years, that's 11 years.
It depends on the business. A lot of things can be built more quickly now. It depends on the business.
No, these are medium.
No, I don't know if 4 years is medium. I think it's probably a year or two, probably to get to a Series A would be my intuition around what the right number is.
It looks like,
sometimes it's
if
less.
you look at some of the stats, okay, we can agree at 10 years then.
Okay.
10 years, and you say, yeah, you get the same, yeah, but I worked my ass off an additional 6 years. So for me, kind of saying, we need that to grow the business, but perhaps I could be better off. And I think that depends certainly on...
Did you actually use the word perhaps? Sorry, did everybody hear that word, perhaps?
That must be a mistake.
Can we write that on the board, perhaps?
I think if you look at what your true outcome or objective is, and if that is money, which I don't think it have to be, but if it is, I simply don't believe, and I haven't seen any numbers to back it off, just to back it up, that you as an entrepreneur is better off take on funding.
Can I respond?
Yeah.
So I think this is a question of fit, in my opinion. That's actually why I made this diagram, because for some folks, they'll try to raise venture capital when they really should be bootstrapping, and for other folks, they'll do the opposite. And that's what I think the big issue is. That's what this is supposed to communicate. So if you're bootstrapping something where you really do need $3 or $4 million in sales and marketing to build it, and granted that the barrier is lower now, technology is less expensive to build, round sizes are smaller, and yes, more is bootstrappable. I agree with all of that. The simple concept that this is trying to convey, and I think is really important to take away, if you need $3 or $4 million to do the sales and marketing or whatever other aspect of your business, if it's more tech heavy, makes a lot of sense because you can build the business if you raise venture capital. If you don't, you're not in a great place. If you don't need to raise that money, then you have a decision to make. If you can start your company for $500,000 or $200,000 with just angel investing, it's some angel money, you have to figure out, are you better off accelerating growth with more capital and more resources, or owning a bigger percentage of it? That's the consideration. That's what this is about. So I think that's a very important point. And frankly, I've seen a lot of companies come in who do not have the potential to scale. They have cool ideas, they're going to make money, but they frankly should bootstrap it. The entrepreneurs will be better off in some of those cases. Now, that's because they can't, I don't believe that their business they're starting is going to be a big business. It's a $1 or $2 million top line. So to me, understanding this consideration and aligning your fundraising strategy with your business is really important, because it makes sure you can maximize your personal returns.
So why don't we push on this a little bit?
Yeah.
Oh, Art, go ahead.
Do you want to say something?
Well, what I say is I think people have to be clear about what venture capital is all about. It's a lot of money, maybe a little bit early, and the VCs are there to work for their investors. They're not there to work for the entrepreneurs. Their interests are sometimes aligned, but not always. And in many cases, what the experience is, and Mark's, we're great friends with DFJ Gotham. We show them almost everything. But that said, I mean, VCs, they want preferences, they want control rights, they want to look at every single piece of your business. And so when you go through not every VC is the same. There are good VCs who are helpful and their interests are at least spiritually somewhat aligned with you. And then there are VCs who actually have no idea what they're doing, and all they want to do is exercise control and maximize the value capture potential in your business. So I think the primary distinction is, are you after value creation or value capture? And if you are a value creator, that is a very, very different thing. If you're a value creator, you have a whole choice of different opportunities in front of you about how you create value. And you pick your choices based upon what the best optimization is between the opportunity to create value and your ability to execute on that value. The VCs are value capturers. They obviously want to create value along the way, but at some point, their way of capturing it is by monetizing it. So if you look at the track record of companies who go through Series B, C, D rounds, and you look at the percentage of founders who are still in leadership roles at that Series D level, it's a very, very small percentage of the overall company. Now, those founders may end up very, very wealthy, but will they have had a good experience along the way? Will they have actually created value for themselves? They may have created wealth for themselves, but will they have created value? And the other component of this is that if you are in markets where
Just
you
to
actually...
clarify, you're saying created a lifestyle for themselves, is what you're saying. When you say value, because
Well, no, because the value, I mean, I have a definition of an ethical business. An ethical business actually creates a positive result for the end user for a product. A wealth creation business creates a positive result for the investor, regardless of the distinctive value created by the consumer of that product, whether it's another business or whether it's actually an end consumer. And so it's a basic fundamental difference in the value orientation between the two sides of the table. And you just have to be very clear about that. When you make those choices, you are making a choice between value capture or value creation. And you see this over and over and over again. If you look at the track record, again, of companies who have sold to Yahoo, to AOL, to large companies who capture value for the VCs, how many of those companies actually survive and become viable, valuable pieces of these larger engines? The track record is unfortunately not great. So, is there a right answer? Is there a wrong answer? There's no religion around any of this stuff. These are all personal choices that people make. People who bootstrap reach points of exhaustion where you just want to liquidate and you want to get out. You'd rather hand it off to somebody else who has the ability to raise the money and bring in a different team so you can go off and just take a break for a couple of years. That's okay. There is no value judgment to that. It is just the reality, and you have to look at it from a very cold set of facts that are really about you personally and what your own personal value proposition is for yourself and the rationale behind why you started that business in the first place.
I just want to get away. I think it's really wrong of you to make out that anybody who has money and they're willing to give it for whatever reason in the context of making money for their investors or making a company better because the money's going to be well spent, it's predatory. I think that's totally false. There are great venture firms. Everything is transparent today, right? You can go on the fund and see who and what everybody's doing. And frankly, we want our client, our company that we're putting money in to succeed. We want you to own as much of the company to be as incentivized as possible. So I don't want you to listen to anything he's saying about this predatory mentality. I think that breeds this sort of anti-money, mentality that money is bad. Money is simply a tool. And the right people working with you are going to help you use that tool efficiently.
I would like to...
I'd actually like to respond to him on your behalf.
Thank you.
Okay. Because the issue, I think, is we deal a lot with companies that start off with nothing, and we generally like companies who bootstrap at the beginning. It's the right way to go. It's another form of capital. It's personal capital. I like it when founders own the vast majority or overwhelming majority of their companies, if not the whole thing. And the fact is that when you look at capital, friends and family capital is terrific. These folks are not going to bother you. They're going to let you do what you do. Maybe they shouldn't let you do what you do, but you have to go through a learning process. And if you look at, we use a lot of angel money out there. And angels are angels, called angels, and they act as angels when they are aligned with the value creation aspect of your business. So the best ones, and there are many folks in the New York Angels who have this characteristic, are repeat entrepreneurs. They've done it before. They have personal value to add. They really are doing it not because they want a return, but because they want to help. And they're taking a bet on a person and on an idea, and they want to see it create value in the marketplace. However, the distinguishing factor between a true angel and others is true angels offer the ability to take an investment without a whole lot of strings. We take angel money generally without any preferences, without significant, I don't know if people here know what a preference is, but it's the ability of the investor to take the money out first and then to participate pro rata in the remaining equity value of a company. They typically come in, they typically help the company. They want to come in as common or be part of pursuit with the founders. Sometimes they come in as a convertible loan because they figure if the company does well enough, they've provided a service, they'll get repaid with maybe some warrants, which is fair, but it's not the same kind of approach, the value capture in legal documentation that a true venture capitalist, a true value capturer will take. And so the variant runs across the board. It's almost like a sliding scale. It starts at angels all the way up to VCs, on the one hand of the value capturers, and then of the value creators. It starts at the bootstrapper end. And yes, it actually, and I believe this, it does extend through some of the VCs, at least insofar as those interests between the entrepreneur and the VCs are really aligned.
So, as a response to that, let's go back to my original definition, which was that, at least the way I see it, anything but taking VC funding is bootstrapping it. And that doesn't mean that I'm allergic to a positive financial inflow into a startup. But I do think that if it comes in the form of venture capital, you've lost. And you went from being an entrepreneur to becoming an employee overnight. And all of a sudden you work for somebody else and you tell yourself that you're an entrepreneur, but you're not. And not only that, you signed up for a 10-year contract, including non-competes and all kind of crap, that you didn't really want to do anyway. So for me, that's losing. But it doesn't mean that I don't want to hack it together from here to there before I figure out that I lost. And that is okay. And I do agree that when angels are behaving as angels, and that means behaving like my mom, and anything beyond that doesn't count. then they do add value, and I am okay with that. But I am really allergic to anybody having equity into a startup and not being there Saturday morning and then tell themselves that they're owners of the company, because they're not. Because if you're not there Saturday morning, 8 a.m., as I am, you're not part of it. We're halfway into the bylaws of figuring out how to write you out.
I'll just respond to this, if that's okay.
Hold on, no. Let's hold questions until the end.
Yeah, I'd just say
So-
I think the view is a little myopic, what I think
A
is
little?
off. Yeah, what I think is off is not your passion for running it. I think that's actually that's commendable. I think what you have a value system, which defines any situation where it's not a business where you're entirely in control, as being a bad outcome. If you take VC money, governance will be put in place. You are building a standalone institution that is no longer the shadow of the founder. It is a company in and of itself. You are building an institution. That is what you're trying to do. That's what you're partnering to do. You're taking money in. A board will be put in place. There will be lots of governance around it to protect everyone involved, because they become very complicated. Lots of shareholders get involved. I think it is a different type of arrangement. It is a different objective. People choose to do this because that is the outcome they want. I don't think there is anything disingenuous or, yeah.
I actually think that's a very good point, and I don't disagree with that. I'm just saying that me personally, I couldn't kind of
then for you, that's a
jump
loss,
that
right?
wall,
You don't want
because
that.
I'll just end up dead on the other side.
Okay.
And
Okay.
I think we're wasting all of your time here in this particular sort of debate. I think there's a lot of other issues you need to understand in terms of the finite
I agree.
issues
I
of
agree.
bootstrapping. When do you do it? When do you not do it? And very frankly, I don't even know. I mean, from your standpoint as bootstrapper, you said you had 2 companies before. Maybe you made enough money that bootstrapping to you is taking your money and putting it in, but other people don't have other exit that had money that they'd be able to bootstrap at the level you did. So it depends. But regardless of that, regardless of any of that, bootstrapping is a good thing if you could do it and it makes sense from a strategic standpoint. Great, wonderful, fabulous. When you come to a strategic moment, you know you need money, and the money may be a certain incremental amount, the people that take the biggest risk are the people who give you the money first, because you have the least to show that actually the money is going to go towards something. Angel investing, just so that you know, has a horrible return. The average number of investments that an angel investor has to make just to possibly break even though everybody thinks that angel investors were all cashmere and gorgeous cars they drive around in, is 1 out of 14 actually can hit it. The average angel investor actually only makes 1 angel investment. The statistics are horrible. The Band of Angels, first angel group in the United States, Silicon Valley, early 80s. They had every top guy smart. They had every deal, every ability to craft the numbers in terms of valuation. 60% were underwater 12 years later. The numbers are horrible. A lot of angel investing is roll the dice. No one has been able to pick in the angel business. It doesn't work that way. It's a really high-risk business. So if, by the way, the angels say, we're taking this huge risk, it's usually pre-revenue almost all the time, right? I think they deserve a little bit of, support for taking that risk. Not a lot. But some of these angel investors are really smart too, and they offer to be on the boards. They offer to help. A lot of great VCs.
We invest
So-
we invest pre-revenue.
Yes. So I don't know. It's just a waste of time to sort of debate the issue of
So-
predatory elements.
So let me go to this subject of timing and characteristics. What are some of the, maybe we could be a little more specific about perhaps the type of company that is more appropriate for bootstrapping versus the type of company that is more appropriate for outside capital. That's number one. And then the dimension of time, where in the life cycle of the company that is. Maybe it's bootstrapping for the first 2 years, and then you kind of realize that there are other things that need to get done. So perhaps you want to maybe address some of that?
Yeah. I think that there's of course a number of well-defined businesses that you can bootstrap, and I think there's a evenly large and probably even bigger number of industries where you cannot. So I think it's quite obvious that none of us here on the panel can start a petroleum refinery and bootstrap it.
But
That's not
let's
going to
keep
work.
it within the
So, but-
terms of software
Yes.
and software companies. There are certain software companies that are more, kind of prone to being bootstrapped versus others. What do you think some of those characteristics are?
Yeah, I think the first one, anything consulting, is of course completely aligned with bootstrapping it.
Okay.
Because for any new employee, you add cost, but you add revenue. So that's almost common sense that any consultancy can be bootstrapped because you have instant revenue and they are somewhat aligned. So I think that's definitely doable and recommended, to put it more polite, in my world. I do think that any software as a service company has the opportunity to bootstrap it. Again, because we've now come into a age where we can scale cost with revenue as
This
well,
one next, if you want.
because of the opportunities with the cloud, however you want to set that up. And when I say software as a service, that could be anything from a application as we know it to a public website and consumer service that you provide, but they're still scalable to the extent where you can actually bootstrap it. And then to answer your second question, which is when you the timing. So whether that is, and I would hate to put a specific number of years on it, but let's say that you're 2 or 3 years into it, which is probably the point where some might look, if they bootstrap it, which means that you will start out slower, to take on some sort of funding. My point is that when I get to that stage where you figure out that we can't take it any further, or we will not be able to attack the European market with whatever funds that we have or whatever cash flow we generate, I would rather just accept that as a fact, and instead of having the VC invest, start an M&A process and say, perhaps Cisco can grow this better for me than having the VC try grow for 2 years and then convince Cisco to pay a factor 10 on it. Why don't I just sell it today then?
Okay. All right. So on the bootstrapping, I think the simple structure here is if it's a tech-light business, it's not heavy in algorithm or it's not a heavy hardware, so SaaS or otherwise website, if you're selling to the consumer population or SMBs you can get to in a cheap way, I think bootstrapping is a good way to go about it early on. If you're selling enterprise sale or you need sales and marketing dollars, you need to raise money. And I think the timing is simply, you should be building an operational model. You should be modeling out what the company needs when. I think a lot of these companies, the big capital requirement at this point, because the cost of technology has obviously come down significantly, is around the sales and marketing expense. So when that starts to phase in, you might want to make a move to raise capital. I mean, I think this stuff is, frankly, like I see a lot of people bored. I mean, this is pretty obvious stuff, right? If you can build a product on the cheap, build it on the cheap and raise money when you needed to spend on sales and marketing.
So I have to say I don't know anything, and I say that on purpose because there are no hard and fast rules in my book to just about anything. And what the most important, what we do is, in our observation, is that 98% of entrepreneurs that we see start building something way too early because they don't know where they're headed. And what we encourage people to do, and what we do with them, is we say, well, let's take your head out of the sand, and let's look around, and let's use, the people who are already out there in the market, whether they're repeat entrepreneurs, whether they're strategic business development people at larger companies who might be your customers or your distribution sources. Let's talk to VCs like Mark. Let's talk to angels who are smart like Brian. And let's kind of really start sussing out whether the value proposition that we have can be of any size. And before we convince our friends to quit their jobs and convince my wife that I'm going to put up some money or take some time off to actually work on this thing. I'm going to make a very, very considered bet on how I'm going to line up all the pieces so that in the shortest amount of time, with the smallest amount of capital, with the right people put together who can actually execute this thing with the greatest amount of certainty and the least amount of risk. And so when this thing is built, I can operate it at the lowest amount of cost and then be able to have investors ranging from angels through VCs to strategics who might be interested in it, but if they're not interested in it, I can keep operating it. And so I don't know, and so when I say I don't know, I said I don't know until I've gone through that process what my prospects are. And what I have found is that, maybe it's because I've been doing this for 25 years and I know a lot of people, that big companies and big players are all looking for innovation. They need the right person to present the idea when it's ready to be presented. And there can be interest developed, and you can start to see paths toward developing your market and making your idea as big as it possibly can be. And that is a fundamental element in my playbook for the first part of bootstrapping before you build anything. And then along the way, we build stuff. We tend to, we have actually a very amazing set of partners, and we convince some of them to move from Silicon Valley to New York. And we start building something where we can start seeing results in a week or two. And then we start testing it out in the market. We start testing it lightweight, testing it, and we start getting some of these partners to sort of sign up, and it's a whole dating process. Hey, we're attractive. Do you think we're attractive? Come and do something with us. Here's what we offer you. And then by the time you're kind of down the road with a product that has some proof of concept, and then you have a lot of these relationships ready to go, and the choice of how you fund is then really up to you and your control.
Right. So let me just stop there for a moment. Look, we've dealt with a lot of different themes here and some opposing viewpoints, obviously. I'd like to take some questions. Anand.
So, what's big? Like, can each of you define what's big? So we've heard that term, like, is it a big opportunity? So how do each of you define what is a big opportunity?
We're running tight. So just quick answers to the questions.
I'll just say it just. Yeah.
How do you define big as an opportunity?
I think it varies by investor is the answer. Investors, when they're putting a venture capitalist, we have LPs that we have to return money to. We have created an investment thesis where we assume that certain success rates within our portfolio and exit size. So depending on what your strategy is, how much risk you take, you often require bigger outcomes. That dictates how big the market is. So it varies substantially, and it's an important thing to understand when you first connect with an investor to understand what their thresholds are.
Yeah. The trends are really fascinating. Listening to the presentations tonight, I'd say there's a few of them that are angel investable. Years ago, probably wouldn't have thought that they were. But the exits are much smaller now. So the rationale associated with big is a lot smaller now. And, you read Rushkoff's book about being able to sort of build companies on your own. I think a lot of that's actually what's going to happen with a lot of these companies. And a lot more angels are going to come into the business at smaller amounts of actual funding. And they're going to be able to provide incremental value to a lot of those companies, and they're going to run very nice businesses. And there'll probably be different models with dividends being paid, just like it would be some kind of return on investment over time. And I think a lot of that has to sort of evolve. A lot of what we do in the angel world is really new. Angel investors are really immature in what they actually do because it's a casual thing. It isn't nearly as professional as the nature of a day-to-day business like a venture capital firm. So angels are really trying to sort of figure it out and are much more driven now to consider smaller investments in smaller exits.
Right there.
My question actually is for Ryan, and I've thrown a situation here that there's an entrepreneur who wants to start a business and has some seed capital. Right? What he'd ideally like to do is get a little bit of revenue and then maybe pull in an angel. At this point of time, you don't want to run for money when you want to have the money. So is there a structure possible with an angel to have a wait and watch scenario that if things work out fine, I'll pull you in to accelerate fast. Or if they don't work out well enough, but I'm on the right track, I could pull you in. Is some arrangement of that sort possible so that, you know.
You mean after they made a first investment?
Yeah. No, not after the first investment, but the entrepreneur has funded the business on his own.
Right.
But he'd like to have a community of angel investors.
There just in case,
In case.
as a safety net?
Yeah.
Yeah, I mean, you'd come in, you'd make a presentation, a good business plan, and look at and review the opportunity there. Yeah, of course.
What's the timeline to make a decision?
Well, the timeline varies. Again, unfortunately, and Art, has shared a lot with me. He has incredible insight. Sometimes the angels get a little carried away and they start thinking they're investment bankers. And they start, trying to digest and chop and analyze. The really great angels are the ones that says, and I had a young man here today, I don't know who you are, but he made a presentation to me over here in 5 minutes. You did, yeah. And I said, wow, there's something special, and I don't know what it is. And I looked at him, I said, who are you? And I felt like an angel. I felt like I had found, heard, listened ever so simply to a concept, to an idea. And there was something that I've funded ridiculous numbers of companies. So there's a certain sense of wisdom that I think I have. I hope. I'm told that no one can possibly have it. But we try and do the deals really fast so that the opportunity is really taken advantage of that moment.
I'd like to add one thing to that.
Sure.
Yeah,
Just
which
try
is
to keep it short.
which is very important. Which is that you're dealing with people, and people are social animals, and your connection to them is all based on relationships. I have relationships that go back 10 years in the VC community, and I are constantly checking out. This is all Mark's colleagues, your colleagues, and these are folks who are my advisory board. And so the question is not, can I tee up an investment from them that I'm guaranteed they're going to invest in 6 months if I need the money? The question is, have I actually kept them informed? Have I built a relationship? Do we have a trusted connection?
Yes.
Where that in a year from now, when I need the money, they may be on hand to actually deliver it. And you hope the financial crisis doesn't hit.
Yeah.
What level of protection of your idea do you need to have before you come to any of you? I mean, I have a provisional patent on an idea. Is that all you have to do? I mean, what do you do? You can't just go around and tell everybody your idea if it's a really big one.
Let me clarify the question. Are you concerned that somebody's going to steal your idea?
Yeah.
Okay. Can we address that very quickly down the line?
You want to address it?
Yeah, I gave you my opinion before. I don't think that your success is dependent on some sort of IP. I think it's dependent on your ability to execute. So
Mark?
Absolutely agree with that. And the second thing I'd say is, one, VCs are busy looking at a lot of plans and don't have time to do it. And two, if they did steal ideas, no one else is going to bring ideas to them in the future. So there's kind of this reputation police aspect out there.
You don't worry about that?
Art?
No. I agree with these guys. The ideas are a dime a dozen. It's all about the execution.
Good. Ryan?
I mean, what are we going to do with it? What do you think? I don't.
Let's,
No.
let's move on. Next.
Okay, so given the situation where bootstrapping has gotten you so far, you need to do something else. We talked about angels and VCs sort of in a cloud. Are there the situations where you absolutely angels won't work at all, you'll have to go straight to VCs, or should you always talk to angels first?
I can give you my 2-second response, which is that I think there's one option that you leave out, which is that you might be able to do an early exit. So why should you grow the company on behalf of the VC? You could exit today, perhaps.
Okay.
If that's your strategy.
Yes.
Yeah, I mean, look, I think it depends on how much capital you need, not only now but in the future. If you're going to need $3 million now, you may be able to find, I've seen groups of angels who have done larger check sizes like that. If you need $2 million after that, $3 million after that, the next VC is usually going to want to see the right governance in place. And some angels do that, some don't. And it just changes the structure. So I think Look, you also may figure out that you don't need a huge amount of money up front. You need some money to kind of prove the next milestone, and angel is a great step. And then you need the big load of capital. The other thing to think about is a lot of investors kind of know behind the scenes, and we all whisper this to each other. Entrepreneurs come in, they need X dollars, and that's the last round they're going to raise. It's a little bit of a kind of a joke around the table for everybody. There's always more money needed for growth opportunities. It always costs more than you expect. It takes longer than you expect. So plan a little bit ahead for more capital, which informs a little bit the first part of what I was saying to you.
Good. Last question. Yes.
How do you deal with, in your experience, have you dealt with startups where they've used credit cards to bootstrap themselves? And the reason why I bring that up is because I hear that in print so often, but I know there's got to be more to the story than what I see in an Inc. magazine. So I was hoping you could comment a little bit more on that, and what's the downsides, and what sort of things do you look at that you will avoid if you see that coming?
I have a investment we made years ago in a company, and if the founders had only realized that they needed a superior VP of marketing with contacts in the entertainment industry, and had found somebody who had mental knowledge, contacts, relationships in the industry they were in, she wouldn't have had to mortgage her house rather than just use her credit cards. All right, so I guess you can try and do that. It's a matter of, gee, I guess I have 12 credit cards in a row, sort of on the limit. I mean, it's ridiculous. Strategic runs your business. Raising the money that you need when you need it. It's not a badge of honor to max out your credit cards.
People do it. I'd say the other thing to be worried about is if you're so worried about going insolvent, you're going to get another job, and it's going to take away time from the core business. The founders need to be able to really focus on building a company, and that requires some financial stability.
Good. Thank you very much. Really appreciate it. Good conversation.